Okay, yes. Sorry, I had to record the meeting. Okay, so I'll read through his profile, and I'm sure that we are also excited to be here. And we have questions already for our speaker. So please kindly pay up attention while I read through his profile and then welcome him in the chat box. Who is our speaker for today's session? Olukayode Olayemi is an equity trader at CSL Stockbrokers Limited, a subsidiary of FCMB Group PLC, with over 10 years of consummate experience in research, relationship management, securities trading, and portfolio management. He has managed equity transactions on behalf of global banks like HSBC, Merrill Lynch, Barclays, and Investec, and local asset managers like Stanbic Pension, ZRM Pension, and several others. In 2018, Kayode's interest in investment and financial literacy led him to establish Thrive Financial Advisors Limited, a financial education company focused on helping young professionals develop their financial capability. He holds a bachelor's degree in economics from Covenant University and a master's degree in finance from Henley Business School, University of Reading in the United Kingdom, where he was the highest achieving African student. He is an associate member of the Chartered Institute of Stockbrokers, as well as an authorized dealing clerk of the Nigerian Stock Exchange. He is also a CFA Level 3 candidate. Huge profile, right? Thank you so much, Kayode, for joining us. We are honored to have you here, and we look forward to a value-packed session with you. Over to you, Kayode. I would share the host button with you.
Okay, all right, thank you. Good afternoon, everyone. Thanks for the invitation. Thanks, all right, for that warm introduction. Trust everyone is good wherever we are. Are we all in Lagos?
I think we have people spread across.
Okay. Yeah. So where you get, could you just put where you're joining us from on the chat so that I know the people I'm speaking to, where you're joining us from, and I can welcome you as well. Okay. Lagos, Ibadan. Okay. Lagos. Okay. So Scotland. Okay. Lagos. Okay. So mostly Lagos and Rock City, Abeokuta. Okay. Welcome everyone. Thanks for the invitation. And it's a pleasure to speak to us about finance. The 3 M's, like Ori mentioned: make money, manage money, and multiply money. She's introduced me, and I'll just introduce the company that I represent, Thrive Financials. We're a financial education company, and we sort of set up the business or the organization to help young professionals develop their financial capability. And what's financial capability? Financial capability is the ability to have the knowledge, the confidence, the attitude, right attitude, and the opportunity to take actions with regards to your finances. The belief is that if we know better, we can do better. And obviously, if we do better, we can achieve better results. So if you're trying to be financially independent or trying to achieve financial freedom, if you know better, then you can take better actions that would help you achieve the results that you want to achieve. Now, from our background, I mean, a lot of us in our schools, nobody teaches us about finance. So we go to school to learn about how to become doctors, bankers, even bankers, yes, engineers, whatever it is, lawyers. And the goal is you're going to school to learn all these things so that you can make money. But you go to school, you start working, you make money, but nobody teaches you how to manage that money. And even the making money part as well, there's still certain things that are important for us to know that we don't get taught in school. And it's when you get into the real world, you stumble into these things. If you don't have anybody that is holding your hands, teaching you a lot of stuff, you'd probably end up making a lot of mistakes that could cost you financially, right? So that's why we set up the platform. And maybe much later, I'll talk about the things that we do and how we do what we do. Before we get started, I'd like us to take a quiz. I'd like us to take a quiz to to sort of gauge our knowledge of personal finance and financial literacy. Now, this is a question that not too many people, well, let's just take the quiz first. And the way it would work is each question would sort of get a group answer. Then I'll take it. So let me just show you what it is. So it's a quiz like this. Let's say we have like 5 minutes to do this. Let's all answer. Let's put our answers in the chat, and then we'll sort of take the consensus, and I'll take it here, and then let's see what we score. So we can start with this one. Okay, so I'm waiting to see your answers in the chat. So I think we have 5 options. So we can just go A, B, C, D. A, B, C, D. Yeah. Okay. I see is for number 1. So suppose you had $100 in a savings account and interest rate was 2% per year. After 5 years, how much do you think you'd have in your account if you left the money to grow? More than 1 or 2, exactly 1 or 2. Okay, A. Okay, all right. So I'll check A. Okay, so question number 2. Most people said A, so that's why I ticked A. Imagine that the interest rate on your savings account was 1% per year and inflation was 2% per year. After 1 year, with the money in this account, would you be able to buy more than today, exactly the same as today, less than today? Don't know, refuse to answer. First answer, C. Okay. Most people have answered C, so less than today. Okay, so the last question is, do you think the following statement is true or false? Buying a single company stock usually provides a safer return than a stock mutual fund. True, false, don't know, refuse to answer. A, B, C, D. Okay. Seeing B's. Okay, so this is a 1C. Should have waited. Okay, so brilliant. So we got all 3 out of 3 questions. So this is a very brilliant class. Well done, guys. Okay, 1 second, please. Okay, so let me jump to our slides and we can start the session. Okay, so first thing, Fintelligent. What's that? Fintelligent pretty means financial intelligence, financially intelligent. At the end of this session, I want every one of us to be financially intelligent. Like I said, if you know better, you can do better. And if you do better, you can achieve better results. And talking about that knowing side of things, earlier this week, I posted something on Instagram about if you have issues with your car, you call your mechanic. If you have issues with your health, you call the doctor. If you have issues with your plumbing, you call your plumber. But for most people, when it comes to finances, they go like, oh, I'll do it myself. And even if they don't say it out loud, that sort of seems to be the attitude of a lot of us. We're trying to figure this thing out by ourselves. And the honest truth is there are nuances that you don't know because you've not been trained, you've not been schooled in these things. Even those of us that are in finance, so let's say you're an accountant, a lot of things that happen in investments that you probably don't know because that's not what you do on a day-to-day basis. So trying to do what you don't know you can lead you to achieving doing things amiss, right? And again, that's one of the goals of this session, to sort of help us get some of the knowledge that we need to start so that we can make better decisions. And obviously, like sometimes if your car breaks down and then you hire a mechanic, if you don't know what to do, if you don't know anything about your cars at all, it's very easy for the mechanic to come and start to bamboozle you with is the crankshaft, is this one that's spoiled. But if you have an understanding a little bit, you don't even need to know you don't need to know how engine works. If you have a little bit of understanding, when the guy comes and he's telling you all whatnot, then you know that, look, this guy's trying to bamboozle you, and then you can sort of maybe get another person or do something else. So the knowledge, it's very, very important. Knowledge. And that's what we're going to try and do today. Okay. I'd come to introduce us later. I did a bit of introduction. And like I said, financial capability is about having the knowledge, the willingness, the confidence, opportunity to take positive actions with your finances. So you must first know, and then you must be willing to do, because you cannot just know and then you don't do, then you don't achieve any results. You also need to have the confidence, because sometimes you know these things and then you're like, are you sure? Am I not sure? But if you have proper knowledge, then you have that confidence that if I invest in this is the result that I'm going to get, and then you take action. An opportunity to take action as well. I mean, if you have all the knowledge and you don't have the opportunity, you don't know about the investment opportunities that are out there, then obviously we're not achieving much results. So financial capability is all this. We'll get into all of them today. Okay, so what I like to start with is to say personal finance is personal at the core. Yeah. A lot of times we're thinking, oh, finance, and then that sort of puts us off. But it is personal. And the reason why it's personal is because what works for one person may not work for the other person. What worked in 1960 may not work in 2022, and what works in London may not work in Lagos. I don't know if you guys have read a lot of financial books and a lot of personal finance and investment books. And then for like a country like in the US, you'll be seeing things like 401k, IRA, 529B, blah, blah, blah. Those things work in the US. Those things are created for the US. If you're living in the UK, for instance, they have ISA. Those things, we don't have them in Nigeria. So it's important to understand that this thing is a very personal thing to you as a person based on your current status and all of that. You cannot just pick something off the street, off the shelf, and just start to apply it on yourself. It may work, it may not work, it may actually give you like bad outcomes. An example that I like to share when I'm talking about this is, you can imagine two people. One person is, let's say, is a software designer, and the other person is a fashion person in Nollywood and all of that. And they both decide, okay, the Nollywood person spends a lot of her or his or her resources on fashion, on grooming and stuff like that. And his neighbor, who is the software engineer, decides to copy him. So in the Nollywood person, maybe he or she has like 50% of our budget, let's say 30% of our budget focused on grooming and looking good and stuff like that. Now you, you in the software engineer, you see this guy is looking sharp always, and you decide to copy him, and you are using 30% of your budget for the same thing. Now, this guy in Nollywood, that what he's doing is probably going to, he's in showbiz business. And that is going to lead to more income because it's a show business, so it's all about the show. But you're a software engineer, you're working in some back office. It probably doesn't matter all of those things, right? So it's important for you to understand that you can't just copy someone. Another example is two guys are working in an office. One is married, or they're both married. Yeah, and there's an investment opportunity that's presented to both of them. So they're on the same level in the office. They earn the same salary. They're sitting beside each other. That's background noise.
Oh yes, I'm trying to fix that. It is from Aisha, so I'm trying to fix that.
Okay, all right, I've done that. Okay, so what was I saying? Yeah, so two people sitting beside each other in the office, they earn the same salary. and someone comes in, walks in, presents an investment opportunity, and they both decide to take it just because this guy thinks because two of us are on the same salary, we're the same. But now, this person A, to do this investment, he's only going to be investing, let's say, 10% of his family's net worth, because his wife comes from a very rich background as well. They have a lot of resources as a family. You, my guy, you decide to copy him because you're sitting beside each other, you're on the same salary, I think you're on the same level. For you, this investment is going to be like 50% of your net worth. Let's say your wife is a stay-at-home, as a housewife, she's not working. So this is like huge. Probably your wife doesn't even come from a rich background like your other person, the other guy sitting beside you. So if this investment goes bad, like you are in trouble. But for this other guy who actually made who made the initial move, it's just 5% of his net worth. His wife is working, she comes from a rich background, he himself comes from a rich background. If that 5% goes to zero, he'll be fine. Yeah, so this just to show us that personal finance is personal. You can't just copy what the other person is doing. You have to figure out what works for you based on your personal circumstance, etc. Now, there are two things that I want us to think about in this conversation about personal finance and personal. And one is definition of wealth. What does wealth mean to you? It's important to understand this because in life, you'd sort of face things where you have to make choices. A lot of times, if you're pushing, let's say you're pushing your career and all of that, you might sort of have to maybe sacrifice maybe family time or your health and things like that. But wealth is not just more, it's more than money. Wealth involves your relationships, it involves your health, your finances, and all of those things. So you want to sort of know what it means to you. Because someone said to me that wealth to him is if he's able to take his family on vacation, he has a house, he can pay his students' school fees. That's what he wants, and he's fine. So each one of us actually need to make sit down and make that assessment. What is important to me as a person? What do I want? And you sort of optimize your life for that. If what wealth is to you is to have money, and that's your definition of wealth, we can argue whether that's the right thing to do or not. We can argue whether you should be all about the money. But let's just say that is what your answer is. You want the money, you want Dangote type of money, then that's fine. Then you know that all the decisions you are making that you're going to make in life is for you to get Dangote type of money. And if for you it's not that, if for you value relationships and that's what you want, then know that you're going to optimize your life, optimize your decisions for that. And because those things are actually wealth. A lot of the jobs that I've gotten in my life haven't been jobs that maybe I applied to. They've been jobs that I've gotten because of relationships, people that I know, somebody recommended me for this, for that. And it's opened doors, it's brought in opportunities, it's brought in money for me. So those relationships are sort of like part of my net worth, even though I can't really value it, but it's part of my net worth. Your health, if you are strong, you're healthy, then it's part of your health, because if someone is unhealthy, they can't go to work. Yeah. So all of those things form part of your health. And if I could list them, I'd say your social wealth, you need to note that down. That's part of your wealth. You need to be investing in that. Your physical health, you need to be investing in that. Your financial wealth, you need to be investing in those areas. Now, I mean, like I mentioned, one size fits one. What works for one person may not work for you. So each person ideally should sit down and design a financial plan, design a financial structure that works for you. And we'll see a little bit more about that. Okay. So the 3 M's, make money. I usually say that this is the most important part of personal finance and finance in general, because it is the money that you make that you can spend. It is the money that you make that you can invest. If your salary is minimum wage, what's minimum wage in Nigeria? 30K. If you are super and you are saving 50% of that salary, that's only 15,000 naira that you can save. let's assume that you have no other sort of income. You're earning just 30K. That's 15K that you can save. 15K times 10 months is 150K. So at the end of the year, all you can save is 180K. Let's imagine a world where there's zero interest. After 10 years, all you save is 1.8 million naira in 10 years. In the Nigeria of today, 1.8 million naira is a lot of money somehow, but it's still not a lot of money. It can't pay your rent in, let's say, Lekki, 1 year's rent. You can't pay that. It can't even buy you a good car. I saw the other day advert of Kia Picanto, like 10, 11 million naira. And when we started to add inflation and all of that into this question. So this guy is earning 15K. He's super with his personal finance. He doesn't waste money. He saves 50%. Fantastic guy. He's been to personal finance school. But there's another guy who is earning 500K a month. This guy doesn't even, let's say he's actually bad with money. He saves just 10% of his money. He's going to save 50K a month times 10, times 12 months in a year. He's saving 600K, right? So that's a whole world of difference between this guy who is saving 50K, is saving 10% of his 500K salary, and you who is saving 50% of your 30K salary. It doesn't really matter, because usually you would hear in a lot of places, it doesn't matter how much you earn. What matters is how much you keep. Yes, it makes sense to say that, because obviously there are people who have earned millions of naira, and because they don't know how to save and manage their money, they end up in zero. But I'm assuming that we're coming to this session to learn about managing our finances, and then we can make better decisions. So the import of that is that what would really matter to us now is what's really important, I think, is for us to make a lot more money than we're currently making. And then on top of that, all the money management skills that we're going to learn, all the money multiplying skills that we're going to learn, we can start to see magic happen for our finances. So first thing I want to say is maximize your salary. So let's say you're working in an organization, you need to be tuned into negotiating your salary. Organizations will not just pay you the highest amount of salary that they can possibly pay you. You need to be able to negotiate that. And those are obviously skills that you need to go and learn. How can I negotiate my salary? How can I have those conversations with my employer? So sometimes, I mean, for instance, an example is, so people get a job, and that happens in a lot of organizations. You get a job, you're on the same level, but you're earning different salaries. And like I showed you a few seconds ago, that can make a whole difference. If somebody is earning 40K a month, somebody's earning 500K a month on the same job, the guy earning 500K can actually do a lot more. Even without, let's not even talk about savings. He can just obviously live a better life, assuming he doesn't have huge cost than this other person who's earning 400K. So maximize your salary. Maximize your benefits. What does this mean? A lot of organizations, maybe they pay you they may give you like benefits, like they say they pay for your gym membership, they pay for your health insurance, they pay for your telephone. Those things have financial value. And you should maximize them. A lot of organizations, you may not even know that these things you're entitled to these things. Some organizations have a plan for them to pay your scholarship, pay your school fees, scholarship, fund your examinations and things like that. If you don't know about these things, then you'll be spending your money on these things, money that you could have otherwise saved or invested, or even gone to enjoy yourself. So you need to maximize your salary, maximize all the benefits that your employer provides you. If whatever you can get from that employer, you get it to the maximum. Obviously, do your job to the best. So that's first point. Second one is develop your relationships. Like I said, relationships are key. You get many opportunities from your relationships, so strengthen them. Network, meet people, talk to people, build your contacts. And LinkedIn is very important. Don't sleep on LinkedIn. I mean, a few years ago, I attended a webinar when someone was sort of teaching about LinkedIn, and I did what she said on that webinar. I went to tweak my LinkedIn profile, I started getting invitation from recruiters about, oh, can we meet? Can we talk? Can we do this? Unfortunately, at that point, I was not really interested in changing jobs and all of that. And I was like, oh, wow, if I had done this all this while, by now I might have gotten like some huge job opportunities or huge job offers. And even my LinkedIn is still not like maximum where it can be. But obviously, I'm not really interested in certain things right now. So it's not sort of top of my priority. But if that's where you are, then it's something that you should focus on. Improve your capacity. Take professional exams. Attend courses. Like, there are certain opportunities that you would not be able to get if you don't have certain qualifications. So whatever it is that you need to do, whatever registration license you need to get it. Soft skill, hard skills, whatever it is, we need to continue to do those things, regardless of what level we are in our careers, entry level, mid-career, and all of that. Obviously, last thing is to expand your income sources. So thinking about here, we're talking about things like side hustles, selling digital skills and all of that. Now, you can have a job in a bank and you can still be earning money, but you create a course, you create an ebook, you create platforms where you can sell. Social media, internet makes a lot of these things easy these days. And I'd implore us to sort of search ourselves and find things that we can do to earn some extra money on the side. I mean, and obviously it could be a distraction from your job. So you need to find that balance. You don't want to do things that are that'll put you in conflict of interest with your employer. That's an ethical thing, right? But it's something for us to think about other sources of income, whether it's selling a course, workshop, trainings, selling something. Social media gives us that platform really these days. You can just create a page on Instagram, tell the world, oh, I sell shoes. And there are people who do that. They'll put shoes on Instagram that we sell shoes and they tell you it's pre-order. And then you order it from them. The most important thing is that you already have that source. You already know, oh, I can get shoes at a cheap price from my guy in Turkey, Taiwan, China, whatever it is, part of the world. You have a sure supply source. And then someone books it on your side, pays you a deposit, you go buy, you sell, you make your commission. Many, many, many different ways you can make money on the side. So it's important for us to pay attention to these things. We need to master the art of earning money. Okay. Now, so that's like the key side of making money. To me, it's about applying yourself, everything that you need to do, your salary, your job, starting a business, just make sure that you're growing your income from year to year. That's one key thing about making money that I like to talk to us about. Now, the second thing about the 3 M's is manage money. Now, it's important because it ties back to that thing I said where they say, oh, it's not about how much you make, it's about how much you keep. It's important how much you keep, because if you're the guy who is earning 500,000 and you spend your whole 500,000 naira every month and you have 0 to save, you are technically worse off than that other guy who is earning minimum wage and is able to save 15K. Because at the end of the year, he will at least have 180K. But you who's earning 500K and you're spending everything, you'd have 0 naira in savings. So it's important for us to talk about this managing money side of things. Now, the first thing that comes to mind when it comes to managing money is having a budget. But I think a budget is difficult because a budget typically means you saying, oh, 10 naira for this, 500 naira for that, 10 naira for this, sort of breaking down all your expenses into very granular details and allocating spending for all of those things. But what I found to be easier is what I call the anti-budget or the reverse budget. Is what you do is you have a spending plan, another word for a spending plan, where you earn 100 naira and you say, okay, 50% of it goes into this, 20% goes into that. 20% goes into some other bucket. So you do it on a high level. An example is what they call the 50-20 30 model, where 50% goes to living expenses. So you know that, okay, 50% of the income is going to go into your rent, your food, whatever it is that are basic essentials for you to live your life. And then you have another 20% that's going for your lifestyle expenses. So you are going out with your friends. Like I mentioned earlier on, you need to network. That involves going out, right? So networking, you're going out, entertainment, you need to pay for data, blah, blah, blah. All those can come under lifestyle expenses. And you say, okay, I'm going to put 20% of my income for this. And then you want 20% of your income for savings, investing, 10% for capacity building. Again, capacity building here is still part of investment, is investment in yourself. So we can say 30% for investment. So when you do this, the important part is this 20% for lifestyle expenses. Now, this is where, I mean, a lot of people get tripped up, where we go out for a party and then we shoot our borders, we're ordering, and then we're now sort of going to the level where we're spending maybe 30% or 40% of our money on eating out and things like that. But if you set your 20%, say 20% is what I'm going to spend on eating out, whatever you do that month, if it fits into that 20%, then no issues, because you've budgeted that 20% of your income you're going to spend on that. It's a plan. Again, to highlight what is important is that you've done that, you can then live your life free without having to think about it. So let's say that you earn your salary and then you put that 20% in this, let's say one of your cards, and that's the card you're taking out, you're using to do all these lifestyle entertainment expenses. So when it finishes, and you know that it is finished. You are not going to be judging yourself on, oh, I bought 2 wraps of this instead of buying one. I'm wasting money. But you don't need to worry about that. The essential part is that you've said, I'm going to be saving 20% of my money. And you are doing that. You've done that. Once your salary comes in, you automatically move that 20% to your savings app or your stockbroker or your investment app, and you do that automatically with a direct debit or stuff like that. Once you've done that, then you are fine. You can do whatever it is you're doing with the rest of your money. The key things here is that you have a percentage allocated to savings and investments. Minimum recommended is 20%. If you let's say you're living with your parents, you're young, you don't have too many dependents, then you should be doing more than 20%. You should be doing 30, 50% or whatever it is you can do. Obviously, the higher it is, the faster you can achieve your financial goals. The higher it is, the more financial stability that you're going to get. This 20% for savings and investment, the higher that percentage is, the better it is for you as a person. So just set that aside and do that first. And then the rest, you can sort yourself out however things pan out. Doesn't really matter. What matters is that you've sorted out your future with this 20% for savings and investment. Now, the next thing is conscious spending. So now you have this 50%, 20% that you're using for your living expenses and lifestyle expenses. You now don't want to, just because, oh, I've said I'm earning 500K, I've said, oh, 50K is going for this, 20K is 20% going for that, then you just blow it out. You still need to sort of think about what you're doing, making sure that you are not being wasteful, making sure that you're planning you're doing things that matter to you. And that's really what this is about. So if you like, let's say you like, some people like eating out, if that's what you do, what you want, you design your budget, design your finances to allow you to do that thing that you love. Because at the end of the day, money is about helping us as a person, helping us to live our lives. Like, we're meant to enjoy ourselves, right? So you're not working hard to make money to save for a future that you don't know about. At least you're working hard today, enjoy yourself. So make sure that you design your budget such that it allows you to spend your finances on the things that matter to you as a person. So those are two important things. And the third thing is, yes, you've said that you're saving 20% of your income now. If I'll link it with this conscious spending, what then happens is you may find ways where you can save money. And then what you then do is that you are able to increase this 20% that you're saving from 20 to 30 and 40 or whatever it is that you can increase it to, just because you have this spending plan that you set from the beginning. And then secondly, you sort of look through your finances to make sure that you are spending money on the things that you want, the things that you need, things that are important to you. So here is, if you have a subscription that you don't need, you cancel it. If you just review your finances generally, that's what that is talking about. Okay. And back to this other slide on spending, you can see that 50% is going on living, 20% is going on lifestyle expenses. That's like 70%. So 70% of your resources are probably going to go into this. And really, that's the reality for a lot of Nigerians today. We're spending a lot of money on living expenses because of inflation, right? So it's very important that you look at this and this other conscious spending side of things, that you look at it like, I'm going to, so for instance, you have cable, you have Netflix, you have Disney Plus, you need all of those things. Those are the questions that come in here, where you need to review your finances to say, okay, what do I need? What don't I need? And cut those things out. Okay, pay yourself first. Discover the secret of savings. Now, the point here is to pay yourself first, because if you earn your salary and you decide to spend and save what is left, you may not be able to do that thing that we said on your previous slide, where I said save at least 20% of your salary. You want to do that 20% first, just like the government does. The government, when your salary is paid, before the money gets to you, they take their tax. So for yourself, for your future, you need to set, okay, my tax rate for myself is 20%. Immediately your salary comes, transfer that 20% to your investment app, to your savings app, or whatever it is you use to manage your finances. You do that immediately, and then you're left with that salary. Because the honest truth is, if you're earning 1 million naira today, and for whatever reason your employer comes and says, oh, we can't pay you 1 million, your salary is now 800K, you're going to find a way to live your life within that 800K. For most people, you're going to find a way to live your life within that 800K. If your employer comes to say, oh, your salary is 500, you're going to find a way to live your life based on that 500. So why not put yourself under that discipline, where I'm living on 800K, I'm saving the 200K, and you'll be surprised at how fast things will work out for you. And then the next thing is your emergency savings. Very, very critical. Emergency savings is it's like an amount of money you set aside, 6 months of your living expenses that you want to put aside to cover you in case of things that are unplanned. So for instance, someone hits your car, how are you going to fix the car? If you don't have emergency savings, then you now maybe have to go and sell some of your investments or borrow money, things like that. So you need to have an emergency savings. And COVID 2020 highlighted this for a lot of people, where people lost jobs, people couldn't do their businesses and stuff like that. But it's the money that they saved that came in handy for them. And even personally, like if you like about 10 years ago, I left my job where I was working, and it was my emergency savings that I used that tided me through the period before I got another job. I was doing some trainings in that period, but I did not need to beg, borrow, or ask anybody for money. I had money that I could use to live my life. And another side of this emergency savings is what I call, it's like a reserve fund, opportunities. There are many times where opportunities come up, and it is those that have cash that can take advantage of those opportunities. An example is in 2020, before COVID started, just before the lockdown started, rather, because of my job and all of that, I'd seen that the Naira was going to drop. Value of Naira was going to go from, actually it was going to go up from 360 was to, I think it went to as 400 initially, and where we are today. So I then checked one of my investment apps, and I saw that, oh, they haven't adjusted their rates yet. They haven't heard. So I immediately bought dollars on their platform. I just took money from my emergency savings and bought dollars platform at 380. back then. I was able to do this because I have emergency savings that I could use to do that. There was a time again that was CBN reduced interest rates. I knew that obviously the bank that I was using for my deposit at that point would not have changed their rates. They would not have heard, or they would have heard, but some of these things can happen very quickly. So immediately I just sent money to them. I want to book this investment. And they're going to have to book it for me at that high rate before they implement that new CBN thing where they've adjusted interest rates. So emergency savings allows you to do these things because you have cash. I call it cash reserves, right? So those are two. And emergency savings, what's emergency savings? Emergency savings is 3 to 6 months of your living expenses. 3 to 6 months. So whatever amount of money you need to cover expenses for 3 to 6 months, you want to save that in liquid. Where do you keep it? You want to keep it in like a high yield interest account. You want to keep some of it in a savings account. Things like mutual fund, money market mutual funds. You need to note that money market, things like treasury bills, those are the places where you can keep your emergency savings. Not invested in stocks, not invested in real estate, not invested in crypto. You want to keep it in its emergency. Emergency doesn't give you notice. So for your emergency savings, you need to be in a place where you can access it very quickly. Okay. Let's rush to this one. Now, this is the very important part of the session, multiply your money, where we're talking about investments. And the thing about investment is a lot of people would come and say, okay, what can I invest my money in? What is hot right now that I can invest my money in? And my answer to them is, I don't know. I honestly don't know. Like if you after this call, you're asking me, what can you invest your money in that is good right now? I don't know. And the reason why I say that is because for me to make that decision about what you can invest in, I need to have a conversation with you to know things like your risk appetite, your risk profile. It's not just, there are many investments, but like I said at the beginning, personal finance is personal. It has to be designed for you as a person, your risk appetite, your personal, your situation. Some people can invest in stocks and they'll be fine. They can put all their money in stocks and they'll be fine. But some people, if they put their money in stocks, they can't sleep because the value can drop, value can go up. And if it drops, they can't sleep. Some people can't put money in stocks because, obviously, like you've seen it, is up today, down tomorrow. That whole emotional thing, they can't handle it. So they can't put a lot of their money in stocks. They maybe more of it in fixed income securities. The implications of that anyway. But the important thing is each person needs to understand themselves before you jump into these things. And again, sometimes maybe what you're saving for is a short-term thing. The investment has a characteristic that is long-term. So if you come and say, well, what can I invest in? And maybe you're trying to manage your money for your next rent. I cannot, and I tell you to go and buy stocks, you may be trapped because yes, stocks do well over the long term, but in a short period of 6 months, 1 year, they may not do very well. And then you need money to pay your rent. The landlord doesn't hear stories that stocks are down. He will need his rent in full. Okay, so that's about investment. But what I want to highlight for us here is, if you remember, if you cast our minds back to like school days, there's this formula that we used to do: simple interest, principal times rate times time, and then compound interest, principal times rate raised to power time, n. That is the formula that drives all of investments. Any investment you are doing is based on, and how that investment grows is based on that formula. So you need to go and learn that formula and master it. Not for anything, and this is all that you need to know actually, really, is that the outcome of your investment is determined by the principal. How much are you investing? And that's what I'm talking about here when I say invest enough. If you're not investing, if you're investing a small principal, then you don't really get too much growth. And if you remember the example I gave earlier, someone who is investing 15K, someone is investing 50K, the results are different because one person has more money to invest, has higher principal to invest. So in general, the more you invest, the larger and faster your portfolio can grow. The other elements in this formula is time. The longer you have to invest, the more time that you give your investments, the faster your investment portfolio can grow. And I'm going to show us an example, a calculator, to see how these things, all these things that I'm saying, how it all works out. So you want your investments to be, investments ideally should be long-term. If you're investing for, let's say, investments are not things that you're doing for tomorrow. It's money that you're putting aside for, that will feed you tomorrow, that will take care of you tomorrow. That's the whole essence of investment. For today, you can be earning your salary and feeding yourself. That's what that 50-70% is for in your spending plan. The 20% is what you are using to prepare yourself for the future, when you're going to stop working, you're going to retire, and all of that. So start early. The earlier you start, the better. I'll show you an example of what I mean by that. Invest and reinvest. If I'm investing and every year they pay me my interest, I eat it, I don't put it back, then there's something in investment called compound interest. Compound interest is based on the fact that, look, I invested 100 naira, I earned 10% interest in the first year, my principal grows to 110. By the next year, my principal is now 110. So the interest I'm going to be earning, it's not going to be 10 naira anymore. My interest is going to be 11. And on and on and on and on like that for the next 20 years. It starts to grow like a snowball rolling down a hill. It just starts to expand. That's the picture of that. So you need to reinvest every return that you get into your investment. Don't just you get your returns, you eat it. It's not going to grow. It's not going to work that way. Invest in different things. You cannot just invest only in stocks. Some people there's a 2008 financial crisis that happened. And people back then, a lot of people were just investing only in stocks. The way financial markets work is different things affect different sectors. And I'll show you, like in 2020 or 2022 right now, the stock market is down. But as the stock market is down, there's certain sectors that are doing well, like commodities, energy, oil prices at like significant heights. Now, if all your money was invested in tech stocks did well in 2020, 2021. If you have all your money in tech stocks, then you're not doing very well today. But for some people who have a diversified portfolio, then they can gain, when 2020, when the market was doing well, they're making money from tech. Maybe they didn't make too much money in oil and gas, or actually lost money. But now they are making money in oil and gas. Their tech stocks are not doing very well. So you need that diversification, that balance in your portfolio, because you never know. Nobody has a crystal ball. Not even the professionals know what's going to happen next in the market, right? So we all need to be diversified across different asset classes, stocks, bonds, industries, countries, not just invest in Nigeria, invest in the US stock market, invest in currencies. Don't just keep all your assets in Naira. Invest in dollar stocks to dollar assets. Very important for us to do that. And invest in the strategy. So have a plan. This is what I'm going to do. One very key strategy is what they call the dollar cost averaging, where you say, oh, every month I'm going to be investing 10K, 10% of my salary. I'm going to be doing this, going to be doing that. You want to have a plan that you can follow. Very, very important to have that plan written out, documented, because too many things are happening. And if you don't have a plan, then you can easily get distracted. So those are the very key points with regards to investing that I want us to pay attention to. When we get to maybe Q&A and time again later, I'll be able to speak to different investment opportunities and things like that. But let me just run through this now. Credit, debt. So when we're talking about borrowing money, very quickly, what debt is? You borrow money from somebody. It can be very dangerous, and it can also be very advantageous. Depends on how you use it. So if you're borrowing money to an example, and I'll just use an example to explain it. A colleague of mine wanted to go to school in America, got a student loan in America, did his MBA, came back to Nigeria. I think from what the gist we heard back then, maybe salary was like 6 million naira per month or so, and his salary before he left maybe it wasn't even up to 6 million naira in a year. So if we ask this person, was debt good? Borrow money, is it good? Obviously, it's good to him because it's changed his life. But there are other people who borrow money and they can't pay. The money is choking them because what? They borrowed money to travel. They borrowed money for expenses, things that don't generate income. And that's what's happened to us in Nigeria. We're borrowing money to pay salaries, we're borrowing money to do things like that. But in some other countries, developed countries, they're borrowing money to build roads, build infrastructure, build things for them. So debt can be good, it can be bad. It's good when you use it for things that generate income. It is good when you borrow in a way that it doesn't become a burden, that it doesn't put you in financial difficulty. So don't borrow too much. Just borrow as what you can handle. And this is not me saying, oh, go out there and start borrowing money. Again, it's me saying debt is not bad. You just need to understand how to use it. And you should be fine if you understand how to use debt. So obviously it means you need to sort of pay attention to how you use and use debt. So there's good debt, there's bad debt. It depends on what you're using it for. Make sure the rates are not too high. Make sure there's a good payment plan for you. And most importantly, again, like I said, what you're using it for grows. Giving, again, giving is very important. Just make sure that you have a plan. The thing that I wrote here, givers need to set limit because takers don't, very important. So if what you can give is 10 naira, then know that that's what you have. People that are going to need money from you, obviously things are tight in the economy right now, so they may be coming to you to ask for 20, 25, 50, but what you have is 10, give 10. And then say, okay, next month I can give you another 10 or whatever it is, but you need to have a plan, set limits on what you're giving. You don't want to help others and then destroy your own finances. It's good to help others. It's very important to help others, but you want to do it in a way that protects your own finances. If you've been on an airplane, they'll say to you that fix your oxygen mask first before you help the next person. So sort out yourself first and help the next person. And again, in that, it's not like when you fix your oxygen mask in the airplane, you are now safe. You've just taken a step. It's just a step. You've done something. You've protected yourself. Then you can start helping others. And then the whole whether you land safely and all that is another conversation. But so my point here is that I'm not saying until you are rich, you're Dangote rich before you should help others. I'm saying that once you've gotten some financial stability, you have a plan, a path, and all of that, then you can start to help other people with their finances. And to the very important part, protect your wealth. You don't want to have done all these things that we've said earlier on, and then you lose your finances because you didn't plan. So you want to get adequate insurance. Health insurance is very important, very, very important. If you don't get health insurance and you fall sick, the medical bills are huge. Medicare or hospital bills can be expensive, can be a lot. And you never know. You don't pray for sickness, but things happen. So you want to get health insurance. What happens is they collect a small amount. You pay like a small premium. And the idea is that if there's 1 million of us, all of us are paying this small premium to the insurance company. Not all of us will fall sick. So they can sort of pull the resources for those that have paid and use it to pay for those that are falling sick. So those that don't fall sick are going to sort of subsidize those that fall sick. That's pretty much how that whole thing works out. Same thing for your car, your properties, whatever it is that you can insure, try as much as possible to insure them. It oftentimes seems like a waste of money, oftentimes, and I have many personal examples of that where it happened to me last year where I was trying to upgrade, but I did not make that decision quickly to upgrade my health insurance. And it cost me money in that short period of time of being indecisive. And can imagine how much I would have saved if I just upgraded my insurance quickly and then not have to pay those things out of pocket. Next one is avoid investment scams. The key thing here is if it's too good to be true, it's likely not to be true. So yesterday, someone sent me an email about one company trying to sell shares of a bank. Companies don't sell shares via email. They put your account number, you pay into a Fidelity bank account of, or sorry to mention any company name, pay into XYZ bank account for so and so. That's how companies sell shares. Yeah. If it's too good to be true, it's most likely not true. Investment companies in Nigeria are registered by the Securities and Exchange Commission, SEC. Their website is sec.gov.ng. You can go on that website and search for that company. If that company is not there, I don't think you should do that investment. They're not a registered company to do investment. Because they have a CAC registration doesn't mean anything. Anybody can get CAC registration. Even children can get CAC registration. But to be SEC registered, that means you are an investment professional. They recognize you, they regulate you, they monitor what you're doing. Those are the people that you should do investments with. And even then, if a company is even still registered with the SEC, that gives you some first level of guarantee. Then you now need to sort of judge what they are doing with their money. Does it make sense? With what they're doing. So if they're promising you fast returns, high returns, be wary of all those things. And we have actually a lot of resources that actually go in depth into these things. And protect yourself against cyber fraud. So here is internet fraud. And the thing I want to mention here is that, look, be careful where you use your card on the internet. Be careful how you use your card, so be careful of links you click on places that you don't know, that are not trusted, that you cannot verify. So someone sends you an email from, say, First Bank. Check. There's a way to check, is this mail really from First Bank? And things like that. So very, very quickly, I think I've gone through the slides. So I want to show us what I said earlier on about the investment calculator. Where is this thing? Okay. Okay, so this is the link on our Instagram bio. So you can always go there and you see this resource. And before we go, we have a lot of resources that you can use. We have an email course that goes in depth into all the things that I've mentioned. We have a starter guide and a newsletter. You can click on all of those things. It's on our Instagram link in bio. Okay, now to the calculator that I mentioned. Okay, now let's do this. Let's say I'm investing 50,000 Naira. This is going to, the result is going to come out in dollars, but let's just imagine that, oops, what did I do? The result is going to come out in dollars, but let's just imagine that this is Naira. So somebody is investing 50,000 Naira, or no, let's say he has zero Naira to start with, but he's going to be investing 50,000 Naira every month for 25 years. And he expects that he's going to get 10% return on average every year. Let's forget about this zero, compounding annually. How much do we think he's going to get after 25 years? Does anyone want to hazard a guess, or I don't know if you do a calculation on your side? What do you think he's going to be getting after 25 years? He's investing 50K every month, or let me even make it 10 years. We'll scale it so that it's easy. So for 10 years, 50K every month. So that means he's going to do 600K a year. Let me see. Oh, can you see my screen?
Oh, yes, I can see your screen.
Okay. So he's investing 50K every month. So that is 10 months is 500K, 600K a year. After 10 years, that's 6 million Naira, right? that he would have invested. But how much do you think he would have based on the fact that his investment is growing at 10% per annum? Just calculate it very quickly because of time. Now, what we're seeing here is 9.56. Someone put on the chart 7.5. This is what he actually gets. 9.56 million naira is what he actually gets. You can see the total contribution is 6 million, but he's coming out with 9.5. That's an additional 3.5 million naira that he comes out with. Now let's change this length of year to 25. And let's calculate again. 59 million naira. Like I said, this is showing us in dollars, but we know we're doing this in naira. So, but if you have $50,000 to invest every month, wow, please, I'd like to speak to you. Yeah, so 59 million naira. And you can see here, the total amounts contributed is 15 million. But what's happened here is interest rate of 10%. This person has been reinvesting the money. Like I mentioned earlier, don't just take your interest and go away. If this person was taking their interest and going away with it, they will have only 15 million. But if they were reinvesting the money, they make 10 naira this year, they put it back. 100 naira next year, they put it back. This is how well that investment does. 59 million, you can see the gap very wide. Okay, so the link is there on our Instagram page. You can click on it and play with it. Look at how much you save every month. Or does anyone want to give us any number? We can try it. If you want to give us a number on the chart, you can try it here to see what the outcome will be. You plug in the number and see how much you can actually come out with after you've been consistent with this thing for a number of years. Okay, let me just take a break here and just ask questions.
Hi, Kayode. Thank you so much. That was insightful. Would you like me to read out the questions for you? So we have some questions.
You have questions? Okay. Oh yeah. Please go ahead.
Okay. Well, thank you so much. That was very insightful. So we have a question here that says that what are the best investment vehicles for 20-year retirement plan?
Okay. Like I said earlier on, the investment that would work for, because I don't know who has asked this question. I don't know anything about you. I don't know how much you have. I don't know when you need the money. You said 20 years, right? But I don't know a lot of things that will determine how much you can invest. But this is what I would say. What you need to do is to, and this is on a high level, and this is how what actually happens is, let's say, what is your age currently? Let's say you're 20 years old now, and you want to invest for 20 years, for the next 20 years when you'll be 40. The rule of thumb is to say you take 20, your age, which is 20, you invest that in fixed income. So you invest your age in fixed income instruments like bonds, treasury bills, etc. And you can invest in these things through like, you can speak to a bank and you can invest in treasury bills. You can, in terms of apps, you can have things like Cowrywise where you can invest in money market mutual funds. Cowrywise, you can invest in money market mutual funds. You can invest in treasury bills through apps like wealth.ng or iInvest. You can invest in treasury bills, bonds, through those sort of things. And then the remaining part is your 80%, which you're going to invest in variable income instruments like stocks, real estate. And to do stocks, you have platforms like Bamboo, where you can invest in US stocks. You have platforms like wealth.ng where you can invest in Nigerian stocks or etc. like that. So what I would say is, first thing is to get what they call a risk profile assessment. You can Google that and you get it you can get one on the internet where you ask you a few questions, you'd answer them, and it would show you like your risk profile. and it would show you how your investment should be allocated to different asset classes. Then you can go on a platform like Bamboo, for instance, and then if it says, oh, invest in dollars, foreign US securities, you can easily invest in like an S&P 500 ETF that shows you that invests your resources in the US stock market. An ETF is an exchange traded fund. S&P 500 is like an index of the 500 largest companies in America. So you can buy an ETF that tracks that index. And what that means is it replicates that index for you. So you have professional investment managers like professional investment managers who've put that portfolio together. And they've bought all those 500 stocks in the S&P 500, they put it into a basket, and you can just buy that basket, and you have like a mixture of all the stocks in that your one portfolio. So that's what that is about. Okay, from the spending, I don't know if that answers your question. Again, like I said,
yes, it does.
It really depends on you as a person, but on a high level, that's what you can do.
Thank you so much, Kayode, for that. We have a question here from Obotolade. It says that from the spending plan slide, 20% was assigned to savings and investments. My question is, am I supposed to take my emergency fund from this, or do I need to take it from my living expenses?
Okay, thanks for that question. Okay, so ideally, what you should do is, before you start investing, you should get your emergency savings. You should fix your emergency savings before you come to investments. So your emergency savings. So before you, let's say this is day one for you. That 20% that you want to save and invest, you should be using it to fill your emergency savings bucket. So once you have filled that up, then you can now come to investment. Another way you can do this is, and obviously like emergency savings is like 6 months of living expenses. If you get to, let's say you've got into 3 months of living expenses saved, and let's say you're doing 20%, then you can now say, okay, I'm going to be doing 10% to emergency savings, 10% to investment. So you can now start doing both of them together simultaneously. But first thing first is get your emergency savings up to 3 months at least first before you start doing investments. Then you can split it 50-50 like I mentioned. And then once you are done with your emergency savings, you've got it up to 3 to 6 months, then you can move to just all the 20% goes into investments. And like I said, that 50-20, those ratios I gave are only a guide. It's not set in stone. Some people can do, maybe their expenses are a lot. Maybe they're doing 60% on living expenses, 30% on investments, and 10% on lifestyle. Maybe they don't go out, they don't have any social life, so they don't have too much of a social life. So it's not a rule like cast in stone, but what is important is that you set your own numbers and at least 20% for that saving and investment. So am I supposed to take my emergency fund? So your emergency fund, you take it out from your savings and investment bucket, fill that bucket first, and then we can do other things.
Okay, I am Montana, and I hope that answers your question. Thank you so much, Kayode. We have one more question here. We have a question from Samuel. It says that I've always believed at least 10% gains of your investment is not a bad investment. What do you think of this, especially considering the current inflation?
Okay, so talking about inflation and investments. So it's a very strange environment that we're currently living in Nigeria and even across the world. If you are having inflation of 20%, what that means is that the value of your money is going down by 20% every year on average. So basically, let's say you have 1 million naira, inflation is 20%. it means that by next year, the value of that money is going to be 800K. 20% of it is gone. And if you're investing that 1 million, it means that 1 million goes at 10%, it goes to 1.1. So ideally, your investment return should be higher than your inflation. Your investment return should be higher than your inflation rate, because just the simple math, 20 is minus 20 plus 10 would get minus 10. But if your investment is 20 and your inflation is, let's say inflation is 18, then at least you're coming out with net real returns of 2. So the answer to the question is that, look, 10% is still a negative real return, but the honest truth is, how many investments are going to be able to deliver 20% return consistently? Not very many investments can do that. So yes, 10%, I mean, long-term, historically, that is a good benchmark. It's a good benchmark for most, for long-term portfolio. The S&P 500, which is the US stock market index, has averaged 10% over the last, 60, 50 years, so 10% ideally is a good number, but just because of the funny environment that we are in right now, it becomes a bit challenging. But what I think is long-term, I don't think inflation is going to be stuck at this 20% for a very long term. Average inflation rates would come down. So I think that, yes, 10% is a good place to be. And then as you can find investment opportunities that help you lift that up. So like investing in stocks and things like that can help you lift that average return above 10%. Question 2, for someone who is struggling with bad debts and bad money management, do you think earning more money will help them fix that, or they need to fix their money mindset? What advice can you give to someone in that situation? Okay, so obviously earning more is not going to fix the challenge if you have a debt issue. And what's this debt issue? Is it because your income is low? That's why you're ending up borrowing money to supplement your living expenses? Because obviously, like, to be honest, the honest truth is Nigeria is a low income environment. Things are expensive, incomes are not very high relative to what's going on. So some of the things that you're saying that look like luxury are not luxuries. It's just that Nigeria is funny in a lot of ways. So, but if it is not that you have a problem where, like, you just want to buy things that you don't need, you just always want to get stuff. If it's just because that, look, your income is not enough and stuff like that, then growing your income is a very important step in all of this. Having a spending plan as well, when you know this is how much I have, following it strictly, this is how much I can spend, this is how much I can live with, following that strictly as well is something that can help in this situation. Again, you said the income is not enough. So, I mean, the thing about this is, how much can you cut? Because I could easily say to you, oh, cut your expenses, but there's only so much you can cut. You cannot cut your expenses to zero, but your income has no upper limit. There's somebody called, the people are earning 1 million a month, people are earning 10 million a month. So there's no end to how much you can earn. So yes, first thing is to try and manage your expenses, try and manage your living expenses as much as you can so that you don't need to go borrowing. But from what you said, the income is not enough. It means that income problem is where we need to put our energy. What can I do to bring in extra income so that at the end of the month, I don't need to go and collect money from this person or that person? So very important, I think, from what I'm seeing here. I don't think that, and this is something that a lot of people may struggle with, where you're thinking that, oh, I'm bad with money. you're not necessarily bad with money. It's just maybe that your income is not enough. It's not necessarily that you're bad with money. It's just maybe that your income could be better. And then you see how that things turn around for you.
Thank you so much, Kayode. Thank you so much. I hope you answered your question. Thank you so much, Kayode. I've had a great time, and I'm sure that others too have. Thank you so much for taking out your time to answer our money-related questions. And for this session, it was power-packed and filled with value. Thank you so much.
All right, thanks for having me. So, like I said, yeah, so just so I try to go through this thing very quickly. But if you go on our Instagram page and the link in our bio, Instagram page is Thrive Financial _. You'd get an email course, 10 emails that would break down all these things that I said to us in like a minute. We break it down for us very quickly. So you can click on link in our bio to access that and a whole lot of other resources that we have on there. So thank you very much, Ari, for having me, and thank you, everyone.
Thank you so much. Thank you so much. We look forward to having you in future. Thank you so much. Yeah, so check it out. Thrive Financials on IG. Thank you so much.
All right, thank you.
Thank you, guys. Bye.
Bye, everyone.